Welcome to the special free episode of Inside Dairy from the Irish Farmers Journal. Today we're giving you a sample of a much larger episode that we've conducted with an analysis of Ireland's dairy co-ops.
Joining us throughout is Agribusiness Editor with the Irish Farmers Journal, Lorcan Roche Kelly, and Lorcan will go through and unpack some of the key figures and trends that are shaping the co-op landscape.
Moving on, so to this figure that you said is probably a better determinant of how the performance of a co-op, profit after tax.
Yeah.
Now again, looking at this graph, and for those listening to the podcast, there are some blanks here. So you've explained already, Canila, we don't have data for it.
Canila is a blank, we don't have data for it, so we're not going to put a number in and we're not going to make up a number.
Look, there's a couple of standout figures here. I can barely see the bar for Dairygold. It's a little bit bigger for our tip.
Yeah.
And they're both less than 2 million.
Yeah.
So profit after tax for both of those co-ops is quite low.
Yeah, I think we give Tip a pass because they were merging two co-ops, they had lots of extra expenses and that, they had some alignment to do as well. So I think we can look at Tip and kind of park them and say, okay.
So you're giving them a free pass this year?
Giving them a free pass on this one. We've given a free pass this year. And Dairygold, like their profit was tiny, and if you look at where their profit was, if they didn't have, and I have been a huge critic of their purchase of this nutrition company, Vita Actives. I think they overpaid for it, and I've said this many times before, but the profit share they got from Vita Actives actually meant they had a positive profit for the year, because they got, I think it was just a couple of million quid was their profit after tax. If you see what they got from Vita Actives, it was 3.5 or 4 million quid, so it kept them in the green for the year, into the black for the year.
So are you telling us that if they didn't have Vita Actives, their core nutritional ingredients business, commodities business, would have made a loss?
Yeah, that's certainly what the figures are telling us.
So they overpaid for milk? Are their cost structures
I don't think they overpaid for milk, because if you look at, like, we can't run and say Carberry, they have a side business that made money and that's paying for milk and that's paying their EBITDA. So if Dairygold have a side business that is giving them some profit and keeping them in the black for the year, then that's a good thing. It means that they paid every cent they could for milk, I think is what we could say for that. Like they absolutely paid the last penny that they could for milk in the year. And so I think it's a good reflection on where the board is, that they could get that number where they wanted it to be. But you want to see some profit retained. It's not something that's sustainable over medium or longer term. You've got to retain the profits. You need that to have...
but as a margin, Lorcan, it's very low. And do we ever have set targets for profit after tax in terms of, covenants for bank loans, or is it more on the EBITDA side that comes in?
More on the EBITDA side. Like covenants for bank loans generally come in, so the earnings have to, your net debt shouldn't be above 2 or 3 times. Like we saw with Tipperary Co-op in 2024, their net debt went to 6 or 6.5 times the EBITDA, and their EBITDA went negative at one point. Because they end up. The problem is what happens then is your interest payments overtake your ability to earn money. So you look at what your EBITDA is before interest. So if your interest payments start taking a huge chunk of that, then you're in big trouble. So that's why banks use that as the benchmark, because they know then how interest rates move up, how much your costs are going to change, and they can keep an eye on you. And they like it to be not much more than 2 times, because that gives everyone a bit of room of where you are in it.
From a farmer's point of view, if we're looking at this from a farmer's point of view, though, Lorcan, once you're able to pay down debt as a co-op, do you really want to see that much profit in the business, or would you prefer to see it in your pocket in terms of milk price?
I think from a farmer's point, you want to see maybe 1% profit retention. So that means 1% of your earnings to be retained. But the co-op needs to have some money there. They need to have some bit of money, because you never know when it's a bad year. Like we saw, if you look at Carberry, they've got, 11.85 million euros in a milk reserve fund that they're going to pay out this year but they've taken that out of their profit, put it aside, and said, okay, we're going to have a bad year because we always will in milk cycle. We'll put some money aside. So co-ops that aren't making a profit after tax don't have the room to do that. So you need to have the room to put that money aside. And farmers really appreciate that when the milk price is at 36, 37 cents. If you give them an extra cent or two, that could be the difference between farmers making a loss and making a profit. So it is important that some profits are retained. I think Tyrone, have a profit, they look at 1.2% is what they want their profit margin to be. And that's fine because they have on an investment cycle at the moment. But if co-ops start making losses year after year or close to loss, then you kind of start getting a little bit nervous about how sustainable the business is.
So remind me now that this is depreciation, which is not a cash cost, but it's an accounting figure. And generally speaking, it's paid out. There's a cost there, whether it's doing up, refurbishing some part of the business. Like, these are all big plants, lots of stainless steel, lots of moving parts. So depreciation, or the cash that would have been spent on depreciation, is gone before profit after tax.
Yeah, well, the cash you spend is cash that you actually are spending on investments.
Yeah.
And you're just writing your investment down over 7 or 8 or 10 or 15 years. So the cash is basically already being spent. They're only accounting for it now.
Yeah.
So it's like depreciation. Someone has to pay for it.
Yeah.
Like, so I prefer EBIT as a earnings figure. That's earnings before interest and taxation. I'd like to see depreciation put into the earnings to get a better view of the health of the company, because depreciation is basically, you have to pay this money back in, because if you're writing something down, you have to get the value back somewhere, and you're writing it down because it is losing value for you. And with these complex arrangements you see in complex companies, like you said, a lot of stainless steel, that needs to be maintained and needs to be replaced every 10 or 15 years.
But are those costs not already in there as well, though, separately to the depreciation? Are those costs in, we'll say,
capital costs don't come into your profit and loss.
Okay.
It's depreciation, how it appears in your profit and loss account. So if you turn around and spend 200 million quid on a dairy plant, you don't write 200 million quid off your profit that year, you write it off over the next 7 or 8 years as is depreciated.
The big standout there for me is Dale Farm.
Yep.
So it's mid-table in terms of the volume of milk produced, but it's second from top in terms of profit after tax. Just over 36 million euros. It's touching Tier Lawn, despite the fact that their Tier Lawn is 3 times bigger.
Tier Lawn is 4 times bigger. It's 16. Yeah, they're a lot bigger. But yeah, it is they're a profitable co-op. They're, like I said, they seem to be a very well-run co-op. They pay good milk price. Again, this number is to March 2025.
Okay.
I get the flag again.
Yeah.
But if you look back over 5 years of Dale Farm results, this is a consistent number. They're consistently making good money, and it allows them space then to make investments, because Dale Farm is at, I suppose, a slight disadvantage being a Northern Ireland co-op, is that they don't have access to Enterprise Ireland joint funding and stuff like that. So they're paying full whack for any investment they're doing. They have the new cheese plant up there that's running well.
Yeah.
They have the contracts with their customers there. So it seems to be, again, a profitable company. And that's good for Dale Farm suppliers, because they know there's money there that this co-op can use to do what they need to do.
And they did give out a 13th payment for 2025, which I think equated to about 1 penny per litre.
Which is substantial
It is. For a typical supplier in Northern Ireland, it's a substantial sum of money. They are retaining, that's a high profit figure, so they've intentionally driven this, or they could have paid an extra more on milk price.
But they could be, it depends where they are, I suppose, in their investment cycle.
That was my next thing. So they obviously have some investments in mind that they're looking for cash to pay down. We'll discuss debt after, but it's they don't have massive levels of debt.
Yes, and it's also if they're from their cheese business, they have a whey business, and if you're looking to invest more in that, it's good to do it with cash than do it with borrowing, because borrowing will always cost you an extra 5% a year. So,
if Dale Farm is performing so well, Lorcan, why was the Arivo deal a big attraction to them?
I think the Arivo deal, if you look at there's one chart there where they look at a few of the charts. Dale Farm and Arivo line up very well, both on size, on scale, but also they're very different businesses. Arivo is basically a powder business, to kind of be crude about it, and Dale Farm is a cheese business. So the two things are, they can work the market very well together. So you could put milk where you want it, rather than Dale Farm building 2 new dryers or Arivo getting into cheese. The synergies work very well. Again, I was asked this question in Balmoral about why it didn't work, and the reason it didn't work, every figure I can look at says this is a brilliant deal. This will work so well. But the problem with it is culture trumps everything in these. And Dale Farm, it's a co-op that's successful, long-standing co-op in Northern Ireland, but they have been kind of, I suppose, slightly viewed as a Northern Ireland co-op. But on this side, we haven't really covered them much. We don't talk much about them down here. So for people in Arivo, Dale Farm were, I suppose, a little bit of an unknown quantity. And I think the boards of both co-ops figured it out fairly quickly that they need to build a relationship over a longer period of time so they can get their members on board. Because if you're going to merge 2 co-ops, you have to have everyone coming with you, because otherwise you're in big trouble. So I think what the boards realise is that the business makes sense, the merger makes sense, everything makes sense from that side. The thing that needs to be worked on is getting the farmers and getting the members on board. So to answer your question, it's an absolute no-brainer of a merger.
Yeah, I think it's important, obviously, and we mentioned in the turnover piece that the marts and everything obviously plays such a big role in the Revo too. So from a shareholder point of view, I think that came into the decision making as well, in terms of the culture and how they view Dale Farm.
Yeah, I think it is. I think basically both co-ops need to work along, and they've said they will work a lot more on this, and we might see in 3 or 4 years' time, now rather than having a merger, the more cooperation we have between them, you could have the effective results of a merger without ever merging at all. But we'll see what happens.
But there could be benefits in that relationship, in a symbiotic relationship between the two of them without a full merger for the next couple of years, which is kind of what they're talking about.
Yeah, exactly, yes.